Hello, everyone. Uh, Good evening, we can say. This is Raed Alkhedr. I'm the Business Development Director at Equiti Group. First of all, I would like to thank the organizer for this nice opportunity to meet with you all guys and have the chance to speak a little bit about what exactly who we are, Equiti, what we do, and at the same time I will have the topic which is how you're gonna allocate your wealth and your portfolio for the last quarter of this year 2024 and as well as how to mitigate the risk of that's like taking place currently nowadays in the global markets. So first of all, I will speak about Equiti. Equiti is a real fintech company. It's a group of companies, we can say. I will start with the brokerage, where Equiti is locally a global local broker. How you say that? It's exactly global broker with a lot of license and a lot of regulations around the world. At the same time, with a local presence and existence in different locations around the world, where we are the best friend of the regulators. And at the same time, we offer a lot of financial services, we can say, not only online trading. We are bigger than that. We serve our clients through Equiti Gold, for example, which is an application dedicated for physical gold delivered to your doorstep through the mobile application. We are speaking about Equiti Pay, where all the transaction, at least within Equiti, being done through our own payment gateways. We are talking about Equiti Invest, where we're gonna see the first mutual funds by Equiti at the beginning of 2025, January. We are talking about so many services and the ecosystem comprehensive in the financial services sector, all in one place, which is Equiti. So from the brokerage side, as we said, we have so many products, so many technologies, so many connections, implementations that we did already to our platforms to serve our clients with the best, let's say, and the best applications and the best platforms, and to enable them to trade over the most wanted products that they are looking for with the best conditions for trading these products. The asset classes that you can trade over Equiti brokerage, it's vary from Forex pairs to shares, commodities, indices, ETFs, cryptocurrencies, and that's happening through multiple platforms where we have Equiti Trader, our own platforms, besides the well-known platforms like MT4 and MT5. We deliver pro market analysis that tailor-made, we can say, to our clients through the portal, very strong and variety of options to analyze the market through the portal, where we have the signal center that provides you with the daily signals for the market. Besides, I used to be the chief market analyst at Equiti. I'm still holding that position a little bit. Me and the team working also on the smart trading reports that we are publishing on a daily basis twice, before the US and before the European sessions. And also we cover the majority of the products there. As we mentioned, we have the asset overview, the signal center, the research terminal, economic calendar, the market news, online resources, academy. There is an Equiti Academy where you can learn everything about online trading from zero to hero. Me and my colleagues as well, we are regular guests on multiple TVs as well. This is the Equiti Academy, and this is the QR code. You can also scan this, and you can access a huge library and a huge academy that teach you everything related to trading, with a very interaction way you can learn, you can answer the quizzes, and so on. Dedicated sales support where we speak multiple languages, and we are, as I said, we partner with the infrastructure of the places that we are at. So for example, we are in UAE, we're regulated by ASCA, and we are partnered with the RTA, with the metro. And you can see easily on Sheikh Zayed Road, our iconic metro station, Equiti, is there, as the first slide was showing that. At the same time, wherever we go, we try to show real support to our clients on the ground, not only by offering them the platform to trade, but really to train them how to trade and provide them with the let's say, do the proper financial literacy around it. We are proud in Kenya that we did in our efforts for financial literacy, we educate more than 3 million people in Africa throughout our arm there in Kenya, where we are also regulated. We have multiple types of accounts between standards, premier, and elite that suits all types of clients. As we said, Equiti Pay allow us to do a lot of options in terms of the payments. So we are so flexible when it comes to payments as we own Equiti Pay. And here I will jump quickly to the core of, as you see here, these are the license that we have as Equiti. We are licensed from multiple places around the world, and we are spreaded. Our offices are spreaded on multiple countries. I will go to the topic of today, which is, I believe it's very important for us to know what to do nowadays with our wealth, with our investments, and where to place the money. First of all, we're going to speak about the key market factors, what's taking place currently. I'll start with absolutely all of you know that the inflation somehow start to cool down. What is inflation? Inflation is the increase of prices of goods and services in a certain country. When we are speaking about these, the inflation, we are talking about the inflation in the developed economies, for example, like the US. When it's cooling down, it means the growth is less. Okay, so the GDP should grow even less. It means that you are squeezing a little bit the growth of this economy. We can say slow growth for the global economy. At the same time, that was combined with the high geopolitical tensions taking place around the world. Beside that, we have the inflation in certain sectors still sticky, not getting down that easy. On the other hand, the monetary policies start to taking a different direction in the world. We saw it in the US, starting cutting the interest rate and leaving that tight policies towards easy expansionary policies where the money value will be cheaper. You are lowering the cost of borrowing the money, so the value of the money will be lower. What does that mean? You need to think, oh, of course, cash value will be lower. I need to put my money somewhere where I can invest. On the economic highlights as well, we're going to look to the GDP expected to grow around 2.5% and even to slow down in the 25 to the 1.7%. Unemployment also is due to increase because long time of a high cost of borrowing money. Companies can't take the money easy from the banks, and the cost of borrowing money is high. So that will force them to start doing layoffs, cutting some investments, stopping some productions, and this is exactly will lead to higher unemployment. Also, there is another interesting indicator that's showing the resignations. There is an indicator for resignations. When it's lower, people, they don't have enough trust that the market is offering better jobs. So they stop from resign. Also, that indicator start to decrease. Means people, they are accepting their situation, their work, their jobs, trying to protect and keep their jobs. On the disinflation process continuing, as we know, because the interest rates were so high, the inflation started getting towards the target at 2%, but yet not at the target. Interest rate cuts, the Fed start the carnival by cutting the interest rate. Another one might be in November, and another could be in January. How big? Is it 25? Is it 50? Look to the future. The future is lower interest rates. It's not about how much, how big. Think about it's lower interest rate. The cost of money will be lower. Stocks might go even higher. You need to be selective nowadays, but later on everything will be more expensive until the Fed figure out that they have to control it again. I'm talking about the US as an example because it's the biggest economy in the world. The risk identifications, where the risk comes from. Microeconomic risks, as we mentioned, we have the inflation risk, we have the interest risk, we have the potential recession, because this is, I believe some of you heard about the soft landing and hard landing of the economy and how they can bring the economy to a better situation, better conditions with lower, we can say, interventions, with less amount of doing big change or shocks to the economy. The risk mitigation strategies, diversifications is the core of that strategy. So the best way to save yourself from all these risks that taking place, first of all, you need to think about diversification in every mean of diversification. Every mean means you need to put equities, bonds, commodities, real estate, cash, diversification, spread your money in multiple asset classes. This is diversifications. Knowing, selecting within the same asset class what exactly you need by diversifications between sectors. So nowadays, we focus more on those stocks that generate you income compared to those with the growth. For example, I will speak about the local market. I will look to the DEWA, company, for example, that is generating income, but it's a dividend stock where always provide you with more dividends, keep giving you dividends, but you are not seeking a gain, capital gain from the stock itself. Nowadays, the focus will be on that type of stocks, where you focus on the stocks that generating to you income, but keep the value safe. You are not looking for a capital gain only. That marathon of AI technology is over. You still can trade some there, place some money there, but on those trusted companies, strong companies. No, there is very small room for, I will say, these kind of risky investments. I will not place a lot there. At the same time, I will keep some room for the cash with around 10% of my portfolio. I put some sort of examples about how you can do the allocations, but you know, when you are looking at your own portfolio, it's the fire from person to another, from industry to another. Where you are located, it plays a big role. So also, when you are monitoring, how you monitor the risks, you have the VIX, the VIX, which is the volatility index, the panic index. If it's high, then people are in panic. You need to drop those risky assets, jump to more safe assets like gold, like Japanese yen, like Swiss franc, all these, they call them safe havens. And you need to look to the commodity price trend. When the commodities prices go even higher, you need to be aware that the market is not, it depends of course on the type of the commodity, but you need to be aware that the market is changing. People are buying commodities, then they don't have the trust in the stocks, they don't have trust in the cash, they are saving the value somewhere. So when these trends going higher, it means there is uncertainty in the market. Quickly, I will not take long. We mentioned so many key risks here, and you are all aware of it. The portfolio impact, how it affects your portfolio. The pressure on the corporate profits, especially in sectors that depends on a cheap credit. Inflation may eat into bond returns, where the yields will be value lower and lower, pushing investors towards real assets, commodities, for example. Last point, let me just show them the example of the allocation. For the growth, which is the history, it was around 40% on equities. Sometimes this number, this percentage, it increased to the 55%, which is a lot. It means people are into risk. They are risk-taking mode. Now, the growth is around 40%. The conservative portfolios is around 30%, where the bonds is getting more popular again and increasing to the 40%. 20% the real assets and 10% the cash. For the alternatives, we are talking about trading online. Alternatives trading, futures, options, hedging, all these kind of strategies are, like we call them, techniques to mitigate risk of having real assets, at the same time taking advantage in the markets. I know it's only 15 minutes. I can speak more, but sorry. And I will not take from my colleagues and my peers' time. Thank you so much, guys. Appreciate it.